Looking for a smart way to secure your family's future while building wealth? Is the Tata AIA Smart Sampoorna Rakshak Pro plan the right fit for your investment portfolio? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Now, before analyzing whether investing in this policy will be a good fit for our investment portfolio or not, let us first understand a few basic details about this policy. So, Tata AIA Smart Sampoorna Raksha Pro plan is a unit-linked, non-participating individual life insurance policy. So some of the key features of this policy are: it offers you high sum assured to secure your loved ones from unforeseen financial events, and flexible premium payment term is also available with an option of whole life coverage. There are two plan options which are available. One is a classic option, another is the Optima option, and this plan is customizable to exactly align with your future financial goals. And you also have a range of debt and equity oriented funds for you to choose from, and you can generate a second income with new partial withdrawal strategies. And there is even a return of 2x of your premium allocation charge and 2x of your mortality charges, which can be highly convenient and useful for you. And there are also smart lady benefits, especially for the female customers. So these are all the features available in this policy. Now let's take a look at the benefits available under this policy. So first, the maturity benefit. So if you survive till the end of the policy term as a policy holder, then you will receive your total fund value, including the top up premium fund value, at the applicable NAV on the date of maturity. So NAV means net asset value. Next is the death benefit, which is given to the nominee or the legal heir in case of unfortunate death of the policyholder during the policy term. So as you can see, the death benefit can be any of the options. So as you can see, these three options, out of these three options, whichever is highest in value at the time of death of the policyholder, that will be given as the death benefit to the nominee or the legal heir. It can be the basic sum assured net of all the deductible partial withdrawals, if any have been deducted from the premium fund value, or the premium fund value, or 105% of your total premium paid up to the date of death. So in addition to this, another thing which will be available to the nominee of the death benefit will be either the approved top up sum assured, or the top up premium fund value, or 105% of the total top up premium fund value. So out of these, whichever is highest in value, it will be given to the nominee as a death benefit. Next, we have the royalty additions and fund boosters, which is the refund of your mortality charge and premium allocation charge. So if you have chosen the classic option, then at the end of the 10th, 11th, 12th and 13th policy years, twice the total mortality charge and premium allocation charge deducted 10 years prior shall be added to your fund value in the form of addition of units. It is not applicable in the Optima option. So these are all the benefits available under this policy. So now let us take a look at the fund options and the investment strategies available under this policy. So this policy gives you the freedom to make investments in line with your personal needs and investment risk profile. You can choose from the 21 investment fund options, or you can choose any one of the two following portfolio strategies. So let us take a look at the 21 fund options you can choose from. You have several funds to pick from. According to the asset allocation strategy you have selected, you allocated regular or single premium, or even your top up premium if applicable, are invested in one or more investment funds. So you can decide to select one or more or all of the 21 funds. So the 21 funds are Emerging Opportunities Fund, Sustainable Equity Fund, Multi-Cap Fund, India Consumption Fund, Top 50 Fund, Top 200 Fund, Super Select Equity Fund, Large Cap Equity Fund, Whole Life Mid Cap Equity Fund, Dynamic Advantage Plan, Whole Life Aggressive Growth Fund, Whole Life Stable Growth Fund, Whole Life Income Fund, Whole Life Short Term Fixed Income Fund, Flexi Growth Fund, Constant Maturity Fund, Target Maturity Fund, Small Cap Discovery Fund, Business Cycle Fund, Rising India Fund, Mid Cap Momentum Index Fund, Discontinued Policy Fund. So out of these all these options, it's completely differentiated based on the category of the risk profile and its asset allocation. The asset allocation can either be allocated to equity, debt, or money market, or even a combined asset allocation. So you can choose it based on your personal needs and your investment needs. Now let us take a look at the investment strategies available under this option. So first is the enhanced smart option. The smart is an abbreviation for enhanced systematic money allocation and regular transfer. So this investment strategy is available till PPT only. It is not available with top up premium funds. So the Tata AIA Smart Sampoorna Rakshak Pro policy holder gives the choice between two funds. One is a debt oriented fund, another is an equity oriented fund under this investment option. So the variety of the available funding, please refer to the policy brochure. So you can see the entire annual or the single allocable premium is parked in the selected debt oriented fund before being systematically transferred into the policyholder's preferred equity fund. It allows you to enter the volatile equity market in a structured manner. Next investment option is a life stage based portfolio strategy. So under this strategy, your portfolio will be structured as per your age and risk profile selected by you. It can either be conservative, moderate, or aggressive. We will automatically shift your investment from riskier asset to safer asset progressively as you age. So we will invest your single premium or your annualized premium between the two funds. So they will invest your single premium or annualized premium between two funds, an equity fund and a debt fund, which is selected by you from their range of funds in a predetermined proportion. So to look at the predetermined portion, you can definitely refer to the policy brochure. These are all the investment strategies and the fund options available for you to choose from based on your personal and investment needs. So now let us take a look at the various charges you will be charged under this policy, because this is a ULIP policy and usually charges will be there. First is the premium allocation charge. So it will be deducted in the form of units at the time of allocation of premium to funds. The net regular premium after your deduction of charges is invested in the funds as per your charge. So there is no premium allocation charge for the Optima option, but this is applicable to the classic option. Next is the policy administration charge. There is no policy administration charge for the Optima option, but for the classic option, a policy administration charge of 0.41% per annum of your annualized premium for regular or limited pay and 0.75% of the single premium from the fifth policy year will be deducted at the beginning of each policy month. And next is the fund management charges. This completely differs based on the fund options you choose from. Based on a high risk fund, low risk fund, it completely, the fund management charge depends on what kind of fund option you choose from, and it ranges from 0.50% to 1.20%. Next is the mortality charge, which is charged for the life cover they provide. So mortality charge is equal to sum at risk, which is multiplied by the appropriate mortality rate for the month based on the attained age of the insured. So based on your age, this mortality charge will also differ. For more details, you can refer to the policy brochure always. And there is a discontinuance charge. So this discontinuance charge depends on the year you choose to discontinue and what is your premium amount and what is your premium paying term. So all these factors determine your discontinuance charge, but there is no discontinuance charge after the fifth policy year and onwards. And there is something called partial withdrawal charge, but usually for other policies, but in this policy there is not something like that. And there is no fund switching charges as well, and there is no miscellaneous charges as well. And finally, you also do not have any premium redirection charge. These are all charges that can be found in other ULIP plans, but here you do not have that kind of charges. So compared to the other ULIP plans available in the market, the Tata AIA Smart Sampoorna Rakshak plan has relatively fewer charges, but however the presence of discontinuance charge, policy administration charge and the premium allocation charge makes the plan still a less attractive compared to other market related instruments like mutual funds, where you do not have that much of charges. So now let us take a look at the advantages and disadvantages of investing in the Tata AIA Sampoorna Rakshak Pro plan. So let's start with the positives first. So the systematic withdrawal facility allows Tata AIA Smart Sampoorna Rakshak Pro policy holder to withdraw the funds at predetermined interval. So you can either choose a chosen rate withdrawal plan or an index based withdrawal plan for withdrawing your funds. You also have the flexibility to pay additional premiums at the top up premium, and the sum assured will increase accordingly. You also have the option to receive your maturity benefit either in lump sum or in the form of periodical payments over a settlement period of 5 years. And next, let's take a look at the disadvantages. So in this policy, no loan facilities available, and the lock-in period is for 5 long years. And during the settlement term, this policyholder bears the investment risk in the investment portfolio. So these are all the potential risks you might be undertaking by choosing to invest in this policy. So you need to consider this also before choosing to invest in it. Now, as we have taken a brief look at how this policy works, now let's move on to the analysis part, where we are going to analyze this policy based on its IRR, internal rate of return, because at the end of the day we invest for the returns we get in a hand, right? That's why we are going to calculate the internal rate of return of this policy. So now, just for calculation purpose, let us assume that a 35-year-old male buys this policy with a sum assured of 1 crore rupees. The policy term is 50 years and the premium paying term is 15 years with an annual premium of 81,301 rupees, and he opts for the classic option. So at the end of the policy term, he will be eligible for the maturity benefit, which is the fund value. So how we are going to calculate the IRR is based on two assumed rate of future investment returns. One is at 4% per annum, which is for the worst case scenario, and 8% per annum is the best case scenario, because this is the ULIP plan where market conditions will also affect its returns. So based on that, we are going to calculate with two assumed rate of returns just to indicate the worst and best case return. It is not guaranteed returns, and they do not in any case represent the upper or lower limits of the potential return. This is completely just for calculation purpose. So if we calculate the IRR in a 4% return scenario based on the Tata AIA Smart Sampoorna Rakshak Pro Plan maturity calculator, then in the worst case scenario you get a fund value of 18.74 lakhs, yielding an IRR of 1%, which essentially provides you with no value addition. 1%, even if you compare it to the rate of interest in a savings bank account, it will give you more interest compared to this policy in a worst case scenario. And especially it is, as it is a market related product, it is not even guaranteed. That means it can even go lower than this. So if you have not invested your money anywhere and kept your money all these years in just your savings bank account, you can get even a more return based on compared to this. So that's why it's providing you with no value addition in the worst case scenario. But this is the case for worst case, right? What is in the case for the best case scenario? At 8%, your fund value is 1.52 crores with an IRR of 5.98% as per the Tata AIA Smart Sampoorna Rakshak Pro Plan maturity calculator. So although the policy term under the plan is 50 years, and the returns are not favorable for a long term investment, because if you have chosen to invest in other market related products, probably you can get good returns compared to this policy, because you are investing in it for, first of all, for 50 years. And for just a long term investment like this, especially in equity, where you can potentially get better returns if you choose to invest in long term like 7 to 10 years, 50 years is definitely will potentially fetch you better returns. But this policy is only giving you returns compared to a debt instrument. Like 5.98% is comparable to a debt instrument like bank FD, where it can give you return of 6 to 7%, where it will be guaranteed. But here it is not even guaranteed, and also it is giving you a return which is comparable to a debt term, so debt instrument. So definitely this is not a sustainable or even a justifiable IRR. So because over time the inflation will increase the cost of your life's financial goals, but while these returns from this plan will not keep up pace with the inflation. That's why the potential shortfall in the required corpus will happen if you choose to invest in the Tata AIA Smart Sampoorna Rakshak Pro Plan. So as we can see, Tata AIA Smart Sampoorna Rakshak Pro Plan is not outpacing the inflation rate despite being a market-linked product, and offers returns that that do not even match that of a debt instrument. What we are going to do is we are going to explore other investment opportunities or investment strategies that can provide us better risk-adjusted returns. So what we are going to do is we are going to separate insurance and investment, because usually ULIPs will combine insurance and investment to provide you with life cover and wealth creation in one place. But here we are going to see if separating these two can be more beneficial. So we are going to use the same metrics from the previous example to examine the following scenario. For instance, for life insurance, for life cover purpose, we have chosen a pure term life insurance policy with more or less similar metrics like Tata AIA Smart Sampoorna Rakshak Pro plan, like with a sum assured of 1 crore, which cost 54,300 rupees annually for the annual premium, and the policy term is for 85 years with a premium paying term of 15 years. So after paying the premium, you have 27,001 rupees left for investment, which can be allocated based on your personal risk tolerance. But here we have chosen an equity instrument. You can also choose a debt instrument with a higher yield of return, but as we are comparing to a market linked product, we are chosen an equity instrument for a better fair comparison. And we have chosen the ELSS mutual fund, which if you have taken a look at its track record, it has consistently proven that it can give you 12% or more returns per annum if you choose to invest in it for more than 7 to 10 years. So this is also a long term investment where we thought investing in ELSS mutual fund can give us better returns, and also it also has tax saving benefits under section 80C. So what we are going to do is, after the initial period investment period of 15 years, this fund is allowed to grow. So the final post-tax maturity value, remember it is a post-tax maturity value, because after accounting for the capital gains tax, the final maturity value is 5.21 crores, but before the pre-tax value was 5.95 crores. So even after accounting for the capital gains tax, it gives you an IRR of 8.96%, which is definitely an inflation beating return, and also the maturity value itself is definitely beats the return Tata AIA Smart Sampoorna Rakshak Pro plan was able to give us. So if we compare this fund, we are allowed to grow the fund until the age of 85 years. So alternately, you also have the flexibility to withdraw the funds as need without any restriction, and the returns are far more superior to the Tata AIA Smart Sampoorna Rakshak Pro plan. So the liquidity and the inflation beating returns are the significant advantages over this investment strategy over the Tata AIA Smart Sampoorna Rakshak Pro plan. So finally, what is the final verdict on the Tata AIA Smart Sampoorna Rakshak plan? So what is the final takeaway from our analysis? As you can see, the Tata AIA Sampoorna Rakshak Pro plan offers life cover protection and market linked investment opportunities. However, the high premium include many charges for policy operations, which reduces the net amount invested in the market. So over the long run, the results in below average returns, because the premium amount you invest for your investment is not invested directly. It is invested only after deducting the fees and the charges. That's why the premium amount you invest, the net amount you invest, is already so small. So over time the returns are also get to be below average return. So while the life cover may seem adequate in this plan, the investment aspect of this plan is unsatisfactory, and also it has a high agent commission. So long term investment should facilitate wealth accumulation, but this plan falls short, making it an unfit investment option. So for an affordable premium and even for an adequate life cover, you can consider choosing to invest in a pure term life insurance policy, because this provides you with a safety net and peace of mind. An investment for your life goals should be done prudently, like you should choose based on your risk tolerance level, and selecting appropriate investment products keep your financial plan on track. And investing insurance and investments separately helps you gain better returns and more beneficial in the long run. So you can definitely build a diversified investment portfolio which can outpace the inflation rate in the long run. But if you're still having doubts on how to customize this plan which tailored to your personal requirements, then you can definitely consult with a professional like a certified financial planner who can create a comprehensive financial plan to meet your financial needs and simplify the whole investment process for you. So you can definitely consult with a professional and invest it through him.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.